Hello, welcome to 2026. I'm very thrilled to kick off season 3 of the S2G podcast and grateful to have all three of you here to do that and to help set the stage for the new year. There's a ton to unpack about the moment we're in and the implications for food and agriculture, oceans, energy. But before we dive into where we're headed, we'd love to take a moment to pause and reflect back on 2025. Last year was full of inflection points, from policy and trade shifts to technology breakthroughs, the acceleration of AI across our organizations, a global energy transition grappling with unprecedented demand and heightened pressure on affordability, both from consumer side and producers. So each of these developments is really setting the stage for the investment landscape we're stepping into now. So I'd love to kick things off to hear a bit from each of you on what are the defining moments of 2025 that stood out to you, and how are those trends poised to shape our sectors in the years ahead? So Sanjeev, why don't you kick us off?
Yeah, no, I think I think some of it was like a continuation of some trends and then some new things that popped up in my view. Obviously, the private markets are still in flux. They're from sort of every asset class. There's been sort of a lack of liquidity in terms of exits. However, there's this great momentum for AI investments. There's continued interest in private credit. I think, but allocators and investors are still feeling. I don't think we've fully recovered from sort of the Russia-Ukraine crisis that then drove interest rates to 4%. So I think from a private markets and it's been sort of I think continued challenge, but pockets of opportunity. Obviously, public markets are overly concentrated on a certain number of stocks that define both sort of the beta and the alpha. I think from an industry perspective, political uncertainty and risk got introduced, particularly in the energy side, but across different segments of the market. I think the consumer, is coming back into the food system as a greater voice. You've seen volume not grow in big food. Power, it's a non-verb adjective AI, and AI data center has been on the industry side. So I think in many ways, to me, 2025 was like a continuation of 3 years of bumpiness on the private market side. Public markets seems to tell a different story. And then industry wise, I think there's a combination of headwinds and tailwinds that define it. We can get into that down the road. But to me, there were inflection points in 25, but a lot of it felt like a continuation of things that were happening for 2 or 3 years. I don't know if Chuck and Aaron have different views. They likely do.
Chuck, Aaron, anything to add?
Yeah, I would agree with what Sanjeev said. And just to add to it, I felt like 2025 was a transition year in many ways of kind of the theoretical down to more operational, in the sense of moving from, does this work to kind of does it hold up under pressure? I think Sanjeev talked a lot about sort of the new risks that were added to the market in 2025. And, because of, tighter capital, geopolitics, kind of reshaping supply chains, AI really being sort of mainstream into day-to-day operations, altogether that really changed the nature of risk and the opportunity set. And I think that's, we'll go more into that in detail, but I think that's really, as we step into this age of adaptation that we've been talking about now for a couple of years, I think it really is the opportunity set. The constraints are actually a positive thing for many of these companies.
Yeah, and for me, it's just sort of the uncertainty that, again, Sanjeev and Aaron talked about is sort of the cornerstone of where business is going. It feels to me like in 25, seem to reinforce that it's accelerating, and the need for management teams, the need for investors like us to be able to, sort of keep up to these trends is getting more and more critical. A lot of the basic capabilities that AI brings, it democratizes a lot of things, a lot of industries, unless you really think about how to build your competitive moat in that world. And so it's certainly created lots of opportunities in heading into 26. So I'm excited.
Yeah. You touched on this a little bit, but when you look across our sectors today, how would you describe the state of the investing ecosystem? Maybe, Aaron, you can start. I know you've been spending a lot of time with investors over the last year, but how do you summarize the moment from an investor standpoint?
I think investors, from what I'm hearing, are cautiously optimistic. I think there's some, if you just step back and look back maybe 5, 7 years ago, a lot of capital was committed, deployed during a significant run up, a little bit pre IRA, but post IRA by the last administration. And I think as a result of that, valuations increased. There was a lot of euphoria about the state of the transition of food and agriculture, energy, and the oceans. I think sober-minded investors are that stayed, a little more balanced during that time, are now sitting there with capital on their balance sheet, the ability to deploy it behind entrepreneurs in a kind of realistic fashion. And I think investors are looking for those types of GPs where they believe that it's not just about sort of buy high, sell higher, but you can really build really strong businesses. And that a little bit of what I was saying earlier, and I think building on what Chuck and Sanjeev were saying, constraints can be a good thing. Risk, when the price of risk goes up, that tends to be a positive thing for the top market participants. And so I think investors are cautiously optimistic. I think the trend still holds. These aren't fads in these markets, but they're really trying to understand who are the top investors out there that see niche opportunities that are not just kind of playing the fad, but can really understand who are the top entrepreneurs to back and founders and companies that are going to really capitalize on what is an ever-changing marketplace.
Yeah. You all have been at this for a while now. We're going into S2G's 12th year. What's fundamentally different about this moment compared to the past? I guess maybe even taking from the lens of deep diving into each sector. Are there particular headwinds or tailwinds you all are watching in food and ag, oceans, energy that might be more nuanced by sector?
Yeah, I think in general, the idea that, Aaron talked about with constraints as a thing, I think there's a reality that's come across. There was a lot of sort of interest in these spaces, and even the Clean Tech 1.0, 15 years ago, the idea that, all sort of these innovations that are happening in all these industries are the same. I just think the way the tech industry is really blown up is it's just different. And so that's what I think the biggest, things that have, to me, fundamentally changed about the recent is this ability to really, play the same game that go to the game that you're actually playing, instead of like trying to be a different sort of asset class or a different thing. Really focus on what helps win in this, what's the right capital structure, what's the right. And I think, over the last year and a half, given that, the markets, or maybe 2 years now, the markets have dried up, from sort of low cost of capital, it's really made entrepreneurs think about the right way to build these businesses, or the right, capital structures, the right amount of capital, the right team size, the right things that are really, the right fit for these organizations to be successful and to have the kind of returns and impact and innovations that we like to see. And so for me, there's been, over this last, sort of year or two in particular, a realism that has entered our space that I think is fantastic, right? It's now we, can see clearly what we need to go do. And, you're starting to see a lot of these companies, especially even within our portfolio, really accelerate the traction that they're getting. And it's taken some time to get there, and really thinking about the right constraints and right company size, and, when to spend on big CapEx opportunities. So it's been awesome to watch.
Sanjeev, maybe obviously you've talked a lot about the age of adaptation. Maybe you can give our listeners a quick summary of what you see those forces being, and is there any, will they continue through the coming years?
Yeah, I mean, I think 3 or 4 years ago, I think we sort of made a strategic decision, or not decision, a thesis that we're going from the era of moderation to the era of volatility, and really the notion that Nixon's world order brought forth globalization, brought forth a demographic dividend, although his decision in financial liberalization, which he very much did with taking us off the gold standard, and global debt from 3 trillion to 300 trillion or more. That global debt led to really outperformance of levered asset classes, private equity, infrastructure, many others. And the other thing that globalization did was really the entry of China and sort of labor arbitrage. And then obviously the fourth is really Moore's law, really got accelerated in these 4 years. So those four forces kind of drove, to me, the last paradigm. I think, to me, 5 forces drive the next sort of 10, 20 years, which is really, moving into parallel computing and AI, to going from a sort of a values-based unipolar world to a more mercantilist multipolar world. And I would even argue what is Venezuela is and a lot of the things happening right now is mercantilistic approaches to multipolarity. The third is an easy price of money or declining price of money when we liberalized financial markets to an unknown price of money. I could give you any side of that trade. Fourth is, I do think that hydrocarbons are not going to be shifting, and so you're going to see, I think, going from 1.5 degrees to a 2 or 2.5 degree, and then the fifth secular force is really demographics, going from a demographic dividend to a demographic tailwind. Each of these factors have like issues. They impact the food system, the energy system, the oceans. I think the combination of the 5 offer a ton of entropy and a ton of sort of anti-fragility opportunity across asset classes: venture, growth equity, buyout, credit, infrastructure. So to me, the next 10, 20 years are about these 5 forces. There's probably others that we're missing, but these 5 forces are pretty profound. I think the big thing to me that I'm very curious about is really, what if you think about GDP growth as the change in demographics times the change in productivity equals GDP growth. That's a classic definition. Demographics, we're actually aging. And so besides Africa, South Asia, Indonesia, and a few other jurisdictions, like there's not a demographic change in demographic tailwind. So it's really a big bet on productivity growth. And it's cheaper, faster, better across sort of different commodity landscapes. The big question to me is, are the channels willing to actually do the thing that's more productive? Like we've seen it in many other sectors, particularly tech. And to me, tech in general is going to be interesting to watch in terms of, if you think of global GDP as 100 trillion, call it, software is 3 trillion, services is, call it, 25 to 30 trillion, maybe less. The big bet that I think of a lot of the AI foundation models is like they're going to take, the TAM is not the 3 trillion growth of software or the 2.5 trillion. It's really, they're going to be able to automate with agents and other approaches that services economy. And so I think entropy and uncertainty like define the era. I think there's a ton of opportunity to what Aaron Chuck in that. And we're going to step into that, I think, with a lot of interesting fit for purpose capital, whether it's missing middle or something else that I think is on the offer to really, sort of take advantage of this moment of entropy and uncertainty. And it's like weekly, monthly that this gets, things that we think would never happen are happening kind of now on a monthly, quarterly basis. And I think the people that are able to grapple with it and be sober about it have tremendous opportunity to create value for investors.
Yeah. Just digging into one of those elements, Sanjeev, I mean, geopolitical shifts continue to happen, and including very recently. What are you watching most closely, and how is that having the biggest impact on investment decisions in our sectors? Are there any surprising ways investors should be thinking about this, or how that it's changing the way you think about investment?
And I think a lot of what we are anchored on are the view that these are all commodities, right? So maybe I can just do a little bit of a quick round robin. American agriculture was built on peak pork demand from China and corn ethanol blending standards post 9/11. In a multipolar world, China's much more reliant on Brazil and Argentina to drive a lot of those raw commodities in agriculture. So TBD, what happens there? And I think there's an enormous geopolitical things that are going to happen in that respect. You look at electrons and energy density, America is the number one producer of oil and gas. It complicates sort of the energy diversification or the energy addition that's driven by AI data centers or anything else, because there's a lot of associated gas, particularly coming out of the Permian, and there's LNG exports, there's combined cycle power plants are going up either in the grid or behind the meter to fund the load growth that's happening secularly because of AI data centers. And so in many ways, like a lot of the thing that you have to underwrite to is geopolitical, particularly because I think we think of this as not a theme, right? We think of these as a series of sectors and subsectors, and that is driving it. I think it includes oceans, it includes this. On the food side, I think there's something to be said around this convergence of food and health, and also this conscious consumer, this demographic change that's occurring in terms of what they want to eat. And so I think it's actually a super interesting time to be doing what we're doing, because I think every one of these factors are changing, and it's not straightforward. And paradigms that lasted for 20, 30 years are no longer assumed to be the paradigm of the next 20, 30 years.
I think it's really important if you really step back and look at the U.S. and the Western world, but particularly the U.S. and our asset base. We are essentially a petrol state. I mean, we are the largest producer in the world of oil and gas, and have massive assets there. We also are one of the best, largest producers of corn, soy in the world as well. Obviously, there's other countries that are threatening that, Brazil, et cetera. But we have massive assets in sectors that we as investors are trying to really back the next entrepreneurs that have built some of the greatest businesses of the last 100 years for the next 100. And that's really the opportunity I think we look at. It's not political necessarily. It's just saying, hey, these are, we move from kind of extractive industries to more regenerative or other better, faster, cheaper industries. And that's really what we're backing to take advantage of this transition more broadly, and leveraging a lot of the resources and capabilities that we've had for 100 plus years in this country and in other countries.
Yeah, and I think 25 was one of those years where I think for many people it did cross the chasm of a green premium just won't cut it, right? Like I think there was some belief for a while that you make a better product and if it's more expensive, that's okay relative to the conventional solution. But I think 25 really was the breaking point of that, and things have to be cheaper, faster, better. Or they just won't be accepted. And I think, we've seen across our portfolio a number of companies that actually have, products or technologies that are cheaper, faster, better. They're just better products than the conventional product. And they've been able to do that because of, this drive that's been happening over the last several years of those constraints to you can't have something that's got this price premium to it relative to, the environmental impact. The consumers are just shown that they're not in mass willing to pay for that, and companies certainly aren't willing to pay for that yet. And that's caused entrepreneurs to continue to innovate and actually build solutions that are cheaper, faster, better, and than the conventional.
One thing that I want to make sure that our audience uses our definition of transition, and it's not like it's not just some political decision. It's really taking the equation that we use is taking useful material or useful energy and turning into useful materials. It's happening for 10,000 years. So this transition is not time bound. It's we did it with photosynthesis and hydrocarbons and whatever comes next. One of the exciting things, I'm sure you're going to go there later, Tanya, is historically we've taken useful energy to useful materials has been largely physical goods, right? I think one of the things, I'm sure Chuck will get into this, is the useful energy to like useful intelligence potentially is actually going to provide a whole new definition of like what the equation of transition is. And I think that's going to be an interesting thing to see play out, whether we're in an AI bubble or not. Clearly, there's going to be a ton of capital expenditure to go figure this out.
Chuck, you've been spending so much time on this AI stuff with our companies. Maybe you could talk a little bit about kind of how you talked about unit economics. I mean, you're seeing AI really drive that better, faster, cheaper.
I mean, we think about the evolution of a company or, sort of idea, validate, process, infrastructure, and scale, and sort of they go through that journey. And I think a lot of companies in 2025 really had thought about the first two aspects of that, the idea and the validation of, sort of taking AI and bringing it into their business. And sort of now they're starting to see, and you're starting to see acceleration of, opportunities, materializing or coming to roost, if you will, across a number of different, parts of certainly the three sectors that we cover. It's really going into that validation and building process and infrastructure. And I think you're going to see a lot of that happening in 2026. This whole idea of AI for ROI, or really thinking about how do you make it profitable and how do you make it so that, the cute stuff and the practicing and playing around with it, sort of that happened in 25 is now really starting to be the foundation for, these businesses accelerating. And I think that that's going to cause a whole bunch of, I think, positive sort of rethinking of models. And it's not just digitizing or building agents to do what we do today. It's really building systems that do it different and better than we do today, which, can be more, again, go back to cheaper, faster, better. It sort of can energize or give those even more ability.
Well, two follow-up questions. One, would love to hear your perspectives on where it's actually changing outcomes and where people are still sort of learning and talking about it more versus the ROI. But also we've talked a lot about, not just operational efficiency, but unlocking new opportunities. So maybe you can comment on AI from both of those respects, Chuck.
Yeah, I mean, it's all over, right? Aaron actually just sent me an article this morning as an example of, some of the major food companies and how they're, using it to reposition or reformat, their products. We're seeing it at, sort of restaurants and thinking about, hyper personalization of guest experience and, using, even my old alma mater, Open Table is sort of bringing in, the ability to have AI, help plan people's weekends and booking of ideas. And, that helps, Open Table get more of their restaurants reservations. My wife over the holiday wanted to make fluffy pancakes. So she asked ChatGPT, give me a recipe for fluffy pancakes. You're seeing, my dad was over, he's got, he uses Ozempic. And so what's an Ozempic friendly diet, and just things like that, that are starting to show up in energy, forecasting of renewable, sort of the intermittency and, when does the wind blow and that kind of stuff, and being able to forecast that using sort of AI. You're seeing that, sort of roll out at, sort of National Grid and a number of other sort of companies doing that. Many of our portfolio companies are integrating it into, we just sold Urbent, which is, an AI company that's really thinking about, reducing the amount of, risk that a line worker or an energy, employee and sees. And so, example after example, you're really starting to see these things come into play and actually have a, meaningful financial impact to these companies.
Yeah. Just going back for a bit to the conversation on cheaper, faster, better, I feel the word affordability has very much entered the narrative in 2025 and is top of mind for many people. Are we entering an era where price is solutions that don't consider price won't scale, or is there still an opportunity for the faster and better category of products to win? How should entrepreneurs be thinking about this as they grow their businesses and try to bring down price over time?
Quick answer to that is affordability is really what you're going towards. Affordability needs to be something identified up front. If you're waiting for the cost curve, in 3-5 years, I think that in a zero rate environment, that works. Today, forget about it. You've got to be affordable kind of early on in that's got to be part of your early kind of phase 0, phase 1 of the business plan.
Yeah, I agree. I mean, I think, we deal in low margin industries that are capital intensive and regulatory sensitive and frankly, pretty consolidated markets. A lot of those channels, they tend to clear on price as opposed to attribute. Now, that could change in certain premium markets, right? We've seen this in food a little bit. There are premium segments of food, there's premium segments of other sectors, but largely, I think price is going to ultimately be your greatest insurance policy to scale. I think so. I don't see it changing, particularly if AI really does it improves labor productivity, particularly in the service industry across whether it's legal services, architectural services, accounting services, et cetera, and you're going to have unemployment rates. At least there's going to be an air pocket where the retraining or the new, anytime I paint a picture of doom and gloom, my economist friends are like, you're just not imaginative because humanity always comes up with new things. But there's air pockets of unemployment that occur in every transition. I think that air pocket's going to be real. I mean, top 10% of American society, I think, is responsible for nearly 50% of U.S. consumption. And if you have greater labor productivity and greater capital productivity that accrues to a certain segment of the population only, you're going to have issues that are profound in housing, in healthcare, in transport, in power, in calories. And there is going to be an air pocket of pain that will occur that I think entrepreneurs and scientists have an opportunity to kind of not have a false choice issue and come up with stuff. So I'm not a techno utopian because I think these transitions have real human cost, and then on the other hand, you're going to have these issues around we're going to print our way out of this, presumably with regard to financing and subsidizing aging, and so you're going to have interesting issues with monetary policy versus fiscal policy versus the purchasing power parity of actual people that have to feed their families.
Yeah. We've talked about affordability and that being core to an entrepreneur's sort of strategy and business model early on. But more broadly, are there other business models that are proving resilient in today's environment? And are there some that are just more difficult to sustain?
Yeah, I think one of the things that you're going to continue to see in business model innovation is sort of the paying for the actual value created rather than buying a license of something. Because, if 10 different people pay licenses of a particular product or a subscription, they all sort of pay the same amount, but probably get very different values out of it. And so with the concept of tokens and whatnot that have been happening in AI, I think that's going to drift across other industries, and where you'll see, how do you do value optimization or value pricing optimization for products? That will continue to, especially because all these companies know our habits when we are on our phones or doing whatever else we're looking at on social media, or searching for being able to understand what is valuable to us. My daughter was over in Europe traveling, and the thing that they all do over there is change their VPN to be a country that's not as wealthy, or out of North Africa when they're booking their airline tickets, because or at least searching for their airline tickets, because they think that the IP address signals the potential wealth of the individual, or the economic means of the individual. Not that she didn't have to register and have her name, and they know that, but like that was some of the sort of thinking that they were doing. And I think that that's going to continue to be the thing, is people are going to figure out how do you find the right value mechanism and charge on value, not just on the product itself.
You talked about this a little bit with Adam and Shale on the last AI in Agriculture podcast, but how do you see that also applying to our other sectors? And I guess a build on that, would love to get your perspectives on what traits are you seeing in founders that are navigating this moment of AI really well?
I mean, to me, it's the embracing of AI, but as Aaron said, and other people, AI is a tool, right? And so it's the contractor, the artisan that's using that tool that's really going to be the value. And I think as we, as entrepreneurs, and certainly what we're doing internally is thinking about how do we enable, our sort of craftsmen, our team, to be able to use this tool in effective ways to help them be better. And I think organizations that, yes, get the efficiency gains out of AI, but also, really think about the effectiveness of these solutions, and are bringing things to market that actually, enable people to get more and move from actually, doing the work to supervising the work. I think that's going to be a massive shift in, I heard a stat recently that one of the number one things on LinkedIn that people are sort of putting as job requirements is managing people. Again, coming back to actually people. And it's, the people are going to need to manage, agents and other things that are going to be, doing the work, but the person in the loop has to be the one who's guiding that and making it, getting the opportunity you can out of it.
Well, it's not just AI that is putting pressure on entrepreneurs. I think it just comes down to leadership. The best leaders at these companies will stand out. We've talked about, and Sanjeev talked at depth about supply chain challenges with geopolitical changes. You've got, the cost of money has gone up. There is not an abundance of resources. In fact, we're now more in constraints, as we've talked about. And so I think it really does separate the top leaders that can drive their organization, that can, put a performance in an environment that is quite challenging. And you wake up tomorrow, you don't know what the headlines are going to be. And so I think what we tend to look for goes back to the sort of the basics of really trying to find and back entrepreneurs that are just very good business professionals, that are great at leading organizations, that really understand what their customers need and are very in touch with those customers, that aren't just trying to build something because it's, the world deserves it in their view. I think there's some of that, but ultimately you've got to meet a customer that's willing to pay, and you've got to be able to probably do it a little bit cheaper, better, faster than what their current solution is. And so I think it does, again, I think AI is a big part of that. It's another kind of wind or headwind in a way, or opportunity if you have the right team around you.
I also think it's going to require a lot of systems thinking approach. Like, we have a business and it's a seed stage, hopefully graduating to a Series A company. And he was like, do you think, like, he was trying to get into trade policy and geopolitics because their supply chain for their particular product was in China, and then they've got to move it up, but where do they move it to? And that's just one. And then he's thinking about, like, using AI for marketing and influence, like the level of, like, dexterity that we've had to go through, particularly the last 3 years since sort of the drawdown. Like, people are, like, talking about geopolitical things in inventory management. I mean, that, like, we lived in a stable period where you didn't need to know geopolitics to run a company.
Yeah.
And it's also how wrong you are too, right? So it's like that humility of like, can you plan for sort of this era of volatility, and from supply chain decisions, inventory decisions, working capital decisions, forecasting margin. That, last year we had a lot of people like, how do I invest in any company when I don't know the margin structure because of trade uncertainty?
Yeah.
And they weren't wrong when they told us this. And so it's like, why are you doing any investing? And so I think you've got to think broadly than your particular sector or subsector.
Yeah.
And maybe that's done with board members and advisors, because not one person's going to be able to do all of it. But I think casting a wider interdisciplinary approach to leadership is going to be needed, because even simple inventory decisions have a ton of interdependency now that they didn't, in 20 years ago.
Where are you seeing examples of this resilience in action? Are there any companies or business models that you see actually getting stronger under all this volatility and pressure? You've hinted at a few, Sanjeev, but I'll open it up to the group.
I think across the board. There's a number of companies. Yeah, go ahead, Sanjeev.
Yeah, I've been very impressed. Really, when Russia invaded Ukraine, the Fed went from 0 to 4%. The world changed. We had a generation of investors and operators that lived and grew up in 2009 to 22. And money was effectively free during that time. There was a ton of risk on capital that went into the system. And I think the people that were like, oh no, there's a world where money is not plentiful, that people are moving on to the next thing, which was AI, not food, not energy, not oceans. I think that was a wake-up call for many of our leadership teams and our own firm. And I think, this makes people like, this is my, I guess, in my own career, this is my third drawdown. 2001, 02 was my first, and 08, 09 was my second. This felt more like 01, 02 to me than 08, 09. But it really separates the wheat from the chaff, from a tenacity, leadership, flexibility, creativity, grit. We've seen that across the board.
What gives you all confidence a solution can survive all this real world complexity that you're talking about as we're doing our diligence and making new investments? Are there things that you're looking for or vetting along the way?
I think for me, it comes back to, differentiation, right? Like making sure that you don't have the same information that everyone else has, right? And so there's all kinds of, pockets of data and insight and information. And I think, a firm like S2G, we really focus on getting to know our markets well and deep, and making sure that we have, connections and relationships with industry. We sort of, keep our fingers on the pulse of all of the different, aspects of these subsectors, and, sort of where they're going. We have conversations with, CEOs down to, managers who are at the front lines of these organizations. And I think that's going to be, where, that human intelligence, that human sort of interfacing is going to need to be an important ingredient and a necessary ingredient in being successful. These general models, as train against the basic internet. And yes, the internet's big, but there's more data behind firewalls than there is outside of firewalls, from like 20 to 1 type of thing. And so, 5% of data is available out there for for everyone in the world to see, and 95% is locked up behind firewalls. And so the organizations that, are taking advantage of, the human, and I don't mean in a negative way, taking advantage, but leveraging the human capital that's out there, and the insights and knowledge that these organizations have built over the last, 10, 15, 20 years, those are, in my opinion, going to be the organizations that win. And I think our team does a tremendous amount of that work, and really focused on how do we make sure we understand these industries really well. And so it gives us insights to be able to, find opportunities.
I was just going to build on Chuck's comment, because I think ultimately what gives me that confidence, but also maybe a little bit about sort of our firm, is we're surrounded, whether it's internally on our team, but also a lot of our entrepreneurs, by winners. These are people who are used to winning in whatever they've done throughout their life, whether it's in athletics, school. They've usually always been at the top of whatever they've done. And I think it's not always because they had the best athletic ability or the highest academics. It's because they worked their ass off mostly, and they also had some skills around that. And then they surrounded themselves with, and we've talked about this on a previous podcast, Tanya, we've surrounded ourselves with people who have humility and are not jerks. And that's important. And I think in this environment where you are faced with all these headwinds, with all this complexity, changing dynamics, having a group around you, and I think this is true of the entrepreneurs we back as well, is making sure that they have around them at the board level, in their own organizations, people that they can trust, that they may not always agree with each other. And we have lots of debates internally even, but ultimately coming to a decision that we believe is the best odds of success and the highest probability to win. And you trust the people around you who have consistently won throughout their lives. I think that gives you confidence that at the end of the day, it doesn't mean you're always going to win. You face setbacks all the time, but in the long run, you're building a franchise and a portfolio that's going to achieve great success over time.
And a culture as part of that franchise.
Yeah. Looking ahead to the new year, where do you see opportunities for our firm and our portfolio in 2026? Anything you're particularly excited about or focused on?
I mean, I think within these 5 forces, there's a tremendous amount of opportunity to across asset classes, whether it's venture, growth, private equity, private credit. So I think there's a bunch of secular forces that are like driving, changes in demand. I think so. The macro side to me always is quite positive. I think the opportunity is really better execution, and that requires talent and changes to talent and really assessing talent. 2 tactics around distribution, pricing, sort of approaches, forecasting. So I think to me, like we're moving in many of our work to like micro opportunities as opposed to like a big micro, right? Like you could have the greatest tailwinds, but if you were bad executing, you're not going to win. To Aaron's point around like ensuring like you keep having a sober view of like what it takes to succeed in these markets, particularly these uncertain, volatile markets, and leaning into that uncertainty, leaning into that volatility, and using that as sort of a great lever. I think the other thing that I see is sort of, in some ways you have to build it in a 21st century way, but, the art of duration, there's going to be some great winners that come out of that, where they've just gone through, the last 3 years and are building, businesses that have profitability, cash flow, scale, and have real value in the market. That is always going to win. I think people that are, a lot of our sectors I find are inelastic goods that have real need, whether the Fed is at 0% or 4% or 6%, whether, there's the world's at 30 wars or 50 wars. I mean, these things where people are going to need eat, they're going to need power, they're going to need transport, they're going to need these basic things. And so to me, a lot of it will be continued dedication to managing uncertainty and volatility and almost building businesses that thrive with that.
Chuck, how about you? What are you looking forward to for our firm and our portfolio in 2026?
Yeah, I mean, I am extremely bullish on sort of where things are at right now. The volatility, I think, is a friend to the entrepreneur, especially as Sanjeev talked about, with good leadership and good leaders in these organizations. And so, I think our approach, or at least how we're sort of thinking about it, is how do we find the right entrepreneurs, and then how do we continue to help support those entrepreneurs through the evolution that sort of these business model approaches and things are sort of in a way that they've got the right amount of capital, the right sort of growth trajectory. They're not overspending. We're not getting capex too soon. We're finding scrappy ways or good business ways to be able to sort of do production or do build the products that they're or services they're selling and creating. And so for me, really sort of continuing to lean into these organizations and help them reach their vision is to me what's the most exciting sort of opportunity in front of us, because I do think there's like I said earlier, a tremendous amount of our portfolio that is starting to reach that sort of moving from process to infrastructure to scale, and really starting to see the growth rates and the efficiency of their models kick in. So it's exciting to see.
Very cool. Aaron, what about you?
Yeah, I think maybe taking it in a little bit of a different direction. I totally agree with what Chuck and Sanjeev said. You got power demand going up, which is a tailwind for us. You've got the right and the left that both agree in this country, in the U.S., that we should eat healthier. I don't think we all saw that coming a number of years ago. But I think, what's those tailwinds allow our team to grow and, face these challenges, fight through them, continue to, build a great business as in S2G that can be a great partner to entrepreneurs and founders. I think for us, we've tried to, we've got 12 years of lessons learned and experience. We've stubbed our toe many times. We've had success. I think all of that together allows us the ability to hopefully be just a little bit smarter every day and improve 1%. And that allows us to be, again, a better partner for investors, for founders and companies, for their customers. A lot of these large strategics that control the channel, we've tried to invest heavily in being their partner. And I think that allows us an opportunity in this face of volatility and age of adaptation, allows us an advantage over others. So I think, this is, while it's, maybe chaos and constraints, in many ways, it's just a great opportunity for groups like us that have the duration that others maybe don't have.
Fantastic. One last question, since this is the first episode of our season 3. Would love to get your thoughts on one questions investors and company leaders working in our sector should be asking now, but aren't. Who wants to start?
I think the big thing that may sound meta, but are you asking even the right questions? Because I think the questions you ask, whether about your revenue, your P&L, your competitors, your capital formation, a lot of those are based on certain assumptions, and those assumptions are more volatile than ever before. And so just making sure you're framing the right questions to yourself, to your board, to your leadership team, to your customers, I think is important, because a lot of things are going back to first principles, I would argue. And first principles are more clouded than ever. So I think there's going to be, and a lot of this, I think, Chuck, is ROI for AI. Like, are you asking the right set of workflow questions? Do you understand your workflows? Because you could potentially save on, if you really are able to automate your workflows, So I think a lot of it will be like first principles thinking on micro execution that I think will provide people an opportunity and I think even ourselves in investment decisions, there's a lot of first principles that we need to continue to interrogate and making sure we're asking the right questions. Often I think, the questions you ask at investment committee don't survive the wild. And so you keep having to be like, did I even ask the right questions at the IC? And similar at the board level, similar at the leadership team meetings of these, portfolio companies. And so I think, I guess, 7 years ago, I would, you weren't really thinking about these questions. How many people today are set up for a blockade in Taiwan? And how many people today are set up for, geopolitical things that never happened before? I don't think that, and how that ripple across. I mean, COVID should have taught us, but I feel like we forgot about COVID.
Yeah. Aaron, Chuck, any builds?
Yeah, I would just add that I think investors need to maybe ask what scales without subsidies. or special handouts, because I'm not sure that's asked enough. There's a number of businesses that we see that, are relying on significant subsidies that I'm not sure are going to be there. And whether it's subsidies or even industrial constraints around the ability to manufacture something at scale. I think when ultimately it comes down to the unit economics, and I think sometimes even the simplest thing, the welder or the ability to weld something, isn't taken into account. And so I think there's some kind of basic fundamentals that aren't related to the intellectual property that is fancy, but it's more the kind of base of a business that I think sometimes investors are overwhelmed by, and they don't think through the full kind of 360 life cycle.
Mm-hmm.
Yeah, so maybe just building on top of both those, and maybe just a little bit different language, but similar is sort of the. I just think asking the question about what's the right to win or the moat, like, that separates these companies, because there are sort of, everything from geopolitical tariff, changes to, what could happen with as Sanjeev just mentioned around Taiwan, or, what is this ability for you to build a resilient, or the organization any investing in, a resilient organization that has, the whole just in time, sort of super efficient organization. I'm not sure is the right model for going forward. For me, it is more thinking about, is there resilience? Is there, a moat that's big and can handle, yes, different aspects of risk in these organizations. And so being able to maybe be not as, close to that Pareto efficiency, and really thinking about, redundancies and other things like that are, built into these organizations, so that they can survive more of these shocks or volatility that happens.
Thank you all so much for joining. With that, we'll end. I know we're over time, but really appreciate you sharing perspectives for the year, and look forward to having you all on the podcast in coming episodes.
Thank you, Tanya.
Thank you.
Thank you, Tanya.
Thank you.